Thanks so much for hopping on. So just as you look at the quarter for NVIDIA next week, what are a couple of things that you and your team are going to be looking at for a sense of not just their own business, but what NVIDIA can tell us, let's say, about the broader AI spend right now?
Oh, well, I mean, NVIDIA is by far the largest supplier in the market. So I think what they tell us is going to really be a good indicator of where AI spending is right now. And I think they're going to have very positive things to say. So we've done checks in Taiwan. The Taiwanese supply chain is continuing to see upward momentum. Had conversations with people selling into their products in the US. The same thing. We've heard it publicly from the CSPs, right? They are spending more on AI. You've heard from companies like Supermicro, where they're expecting sales to roughly double Q on Q, tied to better shipments of pretty much NVIDIA AI racks. And so I think NVIDIA is going to have really positive things to say about Q3, Q4.
You know, I'm curious how you think about the stock at this point. And I ask because when you look at NVIDIA on a valuation basis, we always have this conversation. It's pretty reasonable, especially against a lot of its peers, and really where the stock has been over the last couple of years. It's grown into that valuation and more than in some cases. How do you think about just the stock today, what you're paying for as an investor? Again, trading about 28 times, which compared to what else you can see out there is not crazy.
Yeah, no, so it's not expensive on an earnings basis. The concern that's been around for the last couple months is just the revenue numbers are getting so big that they require so much spend from these companies putting in data centers, and where's the funding going to come from? And that's I mean that is a legitimate concern. Having said that, it's a bigger concern if there's not revenue generated. And if we had this discussion a year ago today, you would be pointing out the fact that a lot of this infrastructure is going to supporting training, which doesn't generate revenue. But now what we're starting to see is that inference workloads are building. Those are what generate revenue. It's what generates profit. And it should be what funds that debt that's being used to pay for these data center buildouts.
And then thinking about NVIDIA specifically and their product roadmap, what are you expecting to see in terms of the discussion around Blackwell sales versus thinking ahead to where Rubin fits in and just NVIDIA's own product velocity here?
I think at this particular venue, right, their Q3 earnings, we're going to hear a whole lot more about Blackwell. With Rubin, it's really starts as a second half 26 story. I think that we see the larger revenue get generated in the 2027 timeframe. So it's still a bit out. Rather, where I think we're going to get tangible, better results or better expectations is the B300, right? So their next iteration of Blackwell, where it sounds like things are ramping really well.
And then finally, just on the China side of it, we still see that story just a little bit just unclear, I guess. I feel like I kind of lose track of exactly where we sit, other than it doesn't seem like NVIDIA has any visibility into sales in China. How are you thinking about that part of the story right now with those non-realized revenues, let's call them, now seemingly comfortably into the tens of billions of dollars?
Yeah, I think everyone's taken China revenues out of numbers. And so if at any point China becomes an opportunity again, that's all a bonus for NVIDIA. I think the other thing to think about, though, is one of the concerns had been that you'd end up with these dual tracks where you've got a China track and a US track, and that China would really offer other countries a path to AI if the US didn't. What we're starting to hear, particularly this week, you had the Wall Street Journal talking about the fact that China has some bottlenecks. And so, while it's not a great thing that NVIDIA still can't sell into China from an NVIDIA perspective, I think some of the concerns around might there be roadblocks in other countries, or could China potentially pick off some of the revenues in other geographies, that some of that fear should be dissipated.
Analysts anticipate that Nvidia will surpass expectations once more when it releases its earnings next week. According to new analysis from Jefferies and Wedbush, Nvidia should surpass projections and improve its outlook as a result of increased expenditure from large tech firms. The findings come as worries over how long AI spending will keep rising caused markets to falter this week. Next Wednesday, after the market closes, Nvidia will release its most recent earnings, and analysts anticipate significant results. The artificial intelligence behemoth is expected to beat and raise, or reveal higher financial metrics than analysts have predicted and improve their future estimates, according to recent notes from Jefferies and Wedbush analysts. Wedbush analysts maintained their $210 price target, noting that the results of hyperscale capital expenditures for the third quarter were usually better than anticipated. More significantly, as they continue to increase investment to support their AI efforts, the large hyperscalers almost universally discussed the assumption of rising spending trends into future periods. On Friday, Nvidia's stock ended the day at almost $190, up almost 2%. Since the year began, the stock has increased 42%, far surpassing the gains of the benchmark S&P 500 index. Since Nvidia is currently the most valued corporation on the market, its stock probably has a significant impact on your retirement and portfolio. The stock prices of several businesses in the AI industry may be impacted by the chipmaker's quarterly earnings performance. As the chipmaker provides a disproportionate share of the AI server value, the Wedbush analyst stated that a large portion of the growth in expenditure from hyperscalers like Microsoft, Alphabet, and Amazon appears to wind up going to Nvidia. But before they see a more obvious way to get a return on their investment in AI, some analysts and investors are beginning to wonder how much the largest tech companies should be willing to spend. In the meantime, a lot of market players have been searching for bubble indicators. Nvidia management should reassure investors about the firm's capacity to meet demand, according to Bank of America analysts, who maintain their price target at $275. The analysts also noted that the company is dealing with high expectations for profitability and growing pessimism regarding AI spending. According to predictions provided by Visible Alpha, Nvidia is anticipated to announce adjusted earnings per share of $1.26 on revenue of $55.28 billion, which is more than 55% higher than the company did at the same time last year. Nvidia's income from data centers, which are processors it sells and that other businesses purchase to run and train various AI models, is predicted to increase by 61% to $49.53 billion. Earlier this week, Oppenheimer analysts raised their price target for Nvidia, describing the chipmaker as the only business best positioned to win in the AI space. After hitting its 52-week and all-time high of $200 per share post-split basis at the end of last month, Nvidia's stock has dropped more than 10%. Additionally, this hesitancy might be excessive for Nvidia as the market oscillates between bubble fears and whether the AI revolution really warrants exorbitant valuations. This is particularly true in light of Nvidia's continued supremacy in chips and its extraordinary growth. Having said that, there are three main reasons why now seems like a good time to purchase Nvidia while it's down. With the AI chip leader scheduled to report Q3 earnings on Wednesday, November 19th, the buy-the-dip scenario appears even more alluring. Naturally, Nvidia is renowned for its explosive outcomes and motivational advice. Following an all-time high in Q2 sales, Nvidia is anticipated to disclose a quarterly revenue record of $54.59 billion, a 55% rise from $35.08 billion last year, and a 17% sequential gain. Better yet, it is anticipated that Nvidia's quarterly EPS would increase by more than 50% to $1.24. Furthermore, the most accurate and current estimate among Wall Street analysts has Q3 EPS set at $1.28, which is 3% higher than the underlying consensus, suggesting that Nvidia may surpass earnings expectations, according to the ESP, expected surprise prediction. 2. The favorable technical analysis of Nvidia. Like me, you might have been able to eyeball Nvidia areas, which have seemed to be between $179 and $180 on these recent pullbacks. During Friday's trading session, there was another small dip to this range, and buyers quickly jumped in, once more. As of right now, Nvidia has closed above its 50-day moving average, green line, since soaring to new highs in October, indicating a short-term uptrend despite recent intraday lows. The gauge price is currently $185 a share. The PE valuation of Nvidia is reasonable. Returning to the argument that bubble fears are exaggerated, Nvidia is trading at 41x forward earnings, comfortably below its 10-year median of 45x and peak of 118x, and not at an excessively stretched premium to the benchmark S&P 500. Oh, and now is a good moment to point you that Nvidia's stock has increased by an impressive plus 24,000% over the past 10 years, giving investors the chance to purchase Nvidia stock during a sharp decline before earnings could be a pleasant present. Although it is never possible to predict how the market will respond to unimpressive news or financial figures, Nvidia is anticipated to release extremely solid quarterly numbers, and its stock typically rises when it does. Quite bluntly, if the broader market experiences the notorious end-of-year Santa Claus surge, astute long-term investors might be waiting for another drop to construct profitable holdings in the hopes that Nvidia will eventually explode higher. Have you ever questioned whether Nvidia is overvalued or a good deal given its explosive growth? You're not the only one who wants to know where the real value is. With just a 0.6% drop this week, Nvidia's stock has risen an incredible 35.1% year-to-date and is up 27.4% over the last 12 months. Recent news reports have highlighted Nvidia's rapid advancements in AI technology and industry alliances, two topics that continue to pique investor interest. Analysts and industry observers have pointed to new developments in chip design and cloud computing partnerships as the main causes of the excitement throughout the previous month. Nvidia receives a 2 out of 6 for being undervalued according to our conventional valuation criteria, but there are several methods to determine a stock's value. We will then examine conventional methods of valuation and give a sneak peek of a more intelligent, comprehensive technique that will be discussed near the end of this video. Method 1. Analysis of Nvidia's discounted cash flow, DCF. The discounted cash flow, DCF model, projects future free cash flows and discounts them to current dollars in order to determine a company's intrinsic value. When determining a stock's true value, this method enables investors to take into consideration both short-term analyst projections and long-term growth scenarios. Nvidia's free cash flow as of right now is $72.28 billion. For the next 5 years, analysts offer detailed projections that indicate cash flows will increase annually. Simply Wallsaint makes additional estimates through 2035 beyond the following 5 years. Notably, by 2030, cash flows are anticipated to be $284.4 billion. The DCF analysis calculates an intrinsic value of 165.9 tons per share based on these assumptions and discounting all future cash flows to the present. According to this measure, Nvidia's stock is currently deemed overvalued, as it is 13.1% above its DCF fair value. According to our discounted cash flow, DCF study, Nvidia might be 13.1% overpriced. Because it indicates how much investors are prepared to pay for every dollar of current earnings, the price-to-earnings, PE ratio is a common valuation tool for successful firms like Nvidia. The PE ratio enables investors to rapidly evaluate value across firms and industries for companies that consistently generate profits. A company's predicted rate of profit growth and the degree of risk it faces determine what constitutes a normal PE ratio. A higher PE may be justified by greater growth and decreased risk. At 52.4x, Nvidia's current PE ratio is significantly higher than both the peer average of 69.8x and the semiconductor sector average of 34.2x. The proprietary fair ratio that Wall Street calculates for Nvidia is 66.1x. This indicator takes into account the company's size, risk profile, industry trends, strong profits growth, and high profit margins. Compared to a straightforward peer comparison or industry average, it offers a more customized benchmark. The fair ratio provides a more accurate indicator of what investors should pay because it is properly adjusted to Nvidia's fundamentals and forecast. The stock looks to be selling below what its growth and risk considerations justify, with Nvidia's actual PE of 52.4x compared to its fair ratio of 66.1x. Using this approach, it might be deemed undervalued. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Yeah, I think that you're seeing the selling pressure is creating an opportunity here for some potential move back towards the recent highs. So I think that, looking at the way the implied vols are structured going into this announcement next Wednesday, it does create an opportunity to position for an upside move and do it in a way to lower the exposure from the get-go by buying a call 1x2. I'm looking at the December call 1x2, the 185 200 call 1x2. And that you can do that for actually a small credit here, and it gives you a capture range higher than where we were trading in the end of October. So the break even is 215 on this to the upside. So it gives you a range to capture to the upside here if we see some higher price action in the stock, particularly after earnings. Now, this is one way to capture that. Now, we do have some risk above 215, then you start to lose money on this trade, but there's still a pretty big capture zone to get us back towards those highs and even above those highs before this becomes a problem trade on the upside.
Well, I mean, tech bull Dan Ives did say that perhaps this tech sell-off would be a buying opportunity. We're already seeing, I suppose, some dip buying this morning. We're off the lows. Yeah. We're seeing companies like Nvidia, as you mentioned, Microsoft, also Apple, just fractionally higher today. We've had some nice numbers for Apple as far as China sales are concerned. What do you make of the action we're seeing out here for this Friday?
Yeah, it's very different than the last couple of days, Sam. And what I mean by that, you pointed out, you are seeing some dip buying going on, like the other couple of sessions where we saw the selling pressure really accentuate as we moved through the session, and some of those high flyers really getting sold where the defensive names were being bought. That is not necessarily the case today. We're seeing, the selling pressure early in the morning. Now we're seeing some buying pressure, and you're seeing those stocks that have been beaten down the last 3 days finding some higher price action while the defensive stocks are being sold. So a different dynamic today. It'll be interesting to see if we're able to get back to unchanged value.